This time last year, you didn't have a care in the world. You didn't have a care in the world. We were 4,700 give or take on the S&P. We were bang on our all-time highs on these markets. Inflation, I'll tell you, Geoff, inflation was transitory. It was in transition, not real inflation, although some of our dear economist friends still don't think it's real inflation. But there wasn't a devastating, worst war on the European continent ever since the Second World War. We didn't have that to look for. We had COVID was behind us as well. Try telling that to the Chinese in 2022. So there's a hell of a lot of issues that we were just blithely ignorant about, or chose to be blithely ignorant. Oh yeah, and the Fed hadn't raised 425 basis points in the sharpest rate hiking cycle for decades. Well, all of that did happen in 2022, and the Nasdaq got pummeled down 33%. The S&P got pummeled down 20% as well. I can carry on, and I will as well. We saw consumer discretionary, Amazon, down 38% this year. We saw tech down 29% in that year as well. Communication services down 40%. We saw Intel, surely not Intel. This is one of the stalwarts, down 49% in the Dow as well. Salesforce down 48% as well. So a hell of a lot of things happened last year. And your bubble was pricked in some fashion, wasn't it? It really was. And your blithe ignorance about those negative factors. The good news is, and we can take a look at the S&P if you like, from the peak that David, our wonderful producer today, tells me about as well. Love to see Katie back as well from New Zealand. She was off for a month, you know. Anyway, so it went at its peak and then came down aggressively throughout the year as well. And what have we got to look forward to at the start of this year? Well, we've got inflation fears. We've got rates probably are going to move a little bit higher, although some of our guests have already said they're already at their peak. You've got recession fears. You've still got your inflation fears as well. But the good news is the market has factored all of that in. This S&P valuation at 38.39 is now back down to about 20 times, which unfortunately, if you look at a historical chart, do that. The first thing you do this year, go on, have a look at your PE chart history on the S&P. In fact, you probably don't want to, because you'll get a bit of a shock, because you now think the market's cheap compared to where it was. History will tell you it can get an awful lot cheaper. Yeah.
You don't want your bubble pricked, do you? Let's face it, in 2023.
Was that me? Am I
but
tech
that
as well?
clearly is what's happening.
Can I just show you tech as well? There you go. Just have a look. No, that's it.
Well, I was just going to say, I mean, are we going to have the same kind of losses at the pace that we saw in 2022 repeated, or is this going to be like the slow football losing air that you wait to see whether there will be any recovery towards the end of the year? I mean, the question, I think, as you say, you know, we start the year with a big fat zero, but actually a very clean slate when it comes to how you think about how you're going to invest this year. So much opportunity, but so much risk and so much danger. And I think what 2022 told us was that traditional approaches to, say, 60-40 portfolio positioning just didn't work. In fact, as Steve has been pointing out to you, you lost a lot of money in some particular sectors of the market, like growth and like tech, but you lost money everywhere. And that was the problem with equities. There wasn't really anywhere safely to go.
Apart from the dollar.
And the problem with bonds was there wasn't really anywhere safe to go. Let's have a look at the Treasury wall. We'll just have a quick run through this, and Steve and I will pick up and we'll have a bit of a chat here. So as you can see here, 2-year yield, 4.45. We've got an inversion on the Treasury curve, which, as all you seasoned CNBC watchers will know, often implies that we're going to have a recession, or at least a fairly bad economic year. As we go out on the curve here, we're 10-year note 3.8464%. And if I tell you that actually over the course of the year, we've seen this 10-year Treasury note up 230 basis points. And the problem with the fact that we've got that Treasury 10-year note up 230 basis points is that it was the same story in all the other bond markets as well. So let's have a look at the European yields, if we might, here. In terms of the bunds, 270 basis points higher. In terms of the Italian paper, we were 348 basis points higher. And in terms of the gilts, let's just show you the gilts again, 269 basis points higher on your key 10-year gilt. So all of those lifts in yields reflected the market's perception that interest rates were just going to grind higher as far as central banks are concerned here, and the market repricing the cost of government paper to reflect that. Let's have a look at the dollar. As Steve pointed out very perceptively, the dollar was one place where actually you would have made money over the course of 2022 if you'd basically just sat in dollars at the start of the year, then you would have been fine here. Interesting this morning, though, we are seeing a little bit of a fight back as far as the yen is concerned. And I think the market's got this interesting idea now about how interest rate policy is changing in Japan and whether the departure of Haruhiko Kuroda is going to signal tightening from the Japanese authorities here. And I'll just mention the JGB plus 40 basis points, the 10-year JGB over the course of 2022, which didn't really reflect the market's view on Japanese paper, but primarily how involved the Japanese government itself was in owning its own bond market.
Exactly, and that is exactly the point, isn't it? And our sarcasm is back with aplomb this year already, because how much can you tell what the market really thinks about anything in Japan, with all due respect to our dear Japanese friends, because the central bank owns it, because the central bank owns such a vast percentage, nearly somewhere in the region of 2/3 of the ETFs on the equity side, because they own a vast amount of the sovereign paper as well. So what are we looking for in 2023? What's the main thing the market's looking for? Well, for a start, it wants to know whether we're going to go into recession. And I've seen, yes, we're going to go into recession. No, we're going to skirt recession. Yes, we will, but it will be brief, and then we'll be up to growth again by the second half of the year. So no one's got a clue really on that front, because all three possibilities are there and make plausible sense. But what about the pivot? Are we going to see a pivot? And that's what the market wants. What about the economy? That's a different issue. The market wants to see about the pivot. Well, yeah, I think rates will stop going up in 2023. There you go. There's my big prediction. I think they will start growing at a lower rate as well. But the problem is, even when this is the thing that the market's going to get a little bit overexcited about when they start seeing more dovish stuff from the central banks. Even if there is a halting of the rate hikes, which could happen after the next couple of meetings in the Fed, and similar in the ECB and perhaps similar in the Bank of England, the fact is rates aren't going down aggressively anytime soon. And even if they start to abate by the end of 2023, that means that the recession is seriously problematic as well. So what do? You move from a scenario where the market is blithely ignorant, as we were at the start of last year, to the threat of interest rate hikes, to the threat of recession, to the threat of inflation primarily. And now we're going to a situation where, okay, the markets, as we said, are not particularly cheap. They might be cheap on some measures, but on traditional metrics, they're not particularly cheap. And yet the markets are still hoping and praying for rate cuts. You're not going to get that. In fact, we could well be at the end of the year exactly where we are now, with a couple of hikes to come and then taking those back off by the end of the year. So actually, your best case scenario is, dare I say it, we're kind of where we are. Then you've got to look at the consumer, and then you've got to look at other factors, which we haven't really mentioned today, such as China as well, because China is in a very, very tricky situation as well. And as you've been pointing out, the reopening hasn't gone too well so far.
Yeah, I mean, what seems to be happening, and I think we got that message loud and clear as we got the investment banks giving us their outlooks for 2023. There was a lot of, it's going to be a year of two halves, because they're anticipating, as you point out, that turn when the central banks say, we've done enough here. Ultimately, policy rates will begin to flatten out and stabilise. So a lot of the market seems to be positioned with this idea of a barbell. Let's go back into bond markets because we think yields will stabilise or fall, prices will be higher, you'll make some money there. Stay with equities that generate cash. So there's a lot of call around owning dividend-type businesses that have real cash flow, that make real profits, that do real business and give money back to shareholders. What a novel idea for 2023. But at the other end of the barbell, there is this idea as well that if all hell breaks loose, you sit in gold, you sit in precious metals, you sit in commodities, or you sit in cash-like instruments at the very short end of the curve. And that will give you some protection if all of the calls about shallow recessions and workers staying in their jobs turn out to be wrong ultimately, and inflation remains much more stubborn here, because there are some peculiar things about how 2022 worked out in the round, and that is the fact that even as we saw the S&P US Treasury Bond Index negative 10.9%, Eurozone government debt indices down 16.8%, and all the losses you've talked about here, unemployment is still only around 3.5–4% in major developed economies, which is quite remarkable given the degree of tightening we've seen. Now, the question mark is that a lagging indicator, and the job losses are already starting to be signed off by HR departments, and your message or your email or your letter will be in the post very shortly? Or are we going to have a peculiar type of very shallow recession this year where people hang on to their jobs and they ultimately see their living standards decline or their household income decline, but they remain employed? And that is the critical part, you know, as to how painful a recession ultimately could be.
Yeah.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.